Good afternoon and good morning. My name is Michael Kimmel, Executive Director of the Reform Pension Board, and I'm thrilled to welcome everyone to our inaugural video conference call. I'd like to start by thanking Len Teitelbaum, to my right, who is our RPB Board Chair, for suggesting we start this new mode of communication with you. With over 330 people participating today from across the reform community, I'm sure I could speak for the entire RPB leadership by first saying that we hope everyone is having a great Passover. But we also want to express our sincere thanks for sending in your thoughtful questions and also for how excited we are to have this opportunity to begin building a new type of relationship with you and all our constituents from across the movement. I'm joined today by Len, Rabbi Howard Shapiro, our Vice Chair, David Baskin, RPB Board Member and Chair of our Investment Committee, and Rabbi Judy Schindler, RPB Board Member, and who in a moment will offer a brief Devar Torah. I also want to acknowledge and thank Maria Rodriguez and Robert Perry, who is here but off camera to help work things from behind the scenes. Before I turn it over to Rabbi Schindler, allow me a moment to explain how the call will go. This is the first time we're using this kind of technology, as well as this being our first call, so please bear with us if we have any glitches. In any case, you'll be able to see us, but we can't see or hear you. If you do have additional questions during the call, please email them directly to us at pensionboard@rpb.org. We have planned to leave time at the end of the call to address some of these questions, but if we can, we will try to respond to them in writing or on future calls. Also, a video recording of the session and the written questions and answers will be made available by next week on our website. After Rabbi Schindler delivers her Devar Torah, Len will offer some brief opening remarks, and then we'll get right into addressing your questions. Thank you again for participating in today's call. Now let me turn it over to Rabbi Schindler. Rabbi?
All right, can you hear me?
We can hear you.
Great, okay. In our Haggadah, there are 4 children, the wise, the wicked, the simple, and the one who does not know how to ask. We are blessed with ancestors who worked to attain our freedom from Egypt, and we need to be aware of the journey so that we can maintain our own freedom and work to attain it for others. Now, the framers of our Haggadah also taught us that our freedom story is not just about the past, but it is a journey that is personal and present. The 4 children of our Haggadah are models for us of how people ask questions of what they know and what they do not know. And when it comes to the Reform Pension Board, there are 4 children as well. As we reflect on our RPB journey, we recognize how blessed we are to have had lay leaders and professionals who fought long and hard over the past 6 decades for us as Reform rabbis and Jewish professionals so that we could have a secure and dignified retirement. Our ancestors ensured that we would receive benefits that are often unmatched by our peers. The Federal Reserve has indicated that the average American has a median $60,000 of retirement funds. With $1.2 billion in assets and 2,700 participants, our average RPB account is $444,000. So the wise child of the RPB asks, what does this all mean to me? This child should be supported to understand how she can properly prepare for retirement. She should be encouraged to try and negotiate a 15% congregational contribution and make an additional 3% personal allocation. The wise child should be guided to meet annually with a financial advisor, whether it is the Ceridian advisor offered through the RPB plan or a qualified advisor in their own communities. With this child, we talk about the freedom that a solid retirement savings can provide. The wicked child asks, what does this all mean to you? To you, those who are near retirement, and not to me as I am a young rabbi. This child should be welcomed to the RPB table. We should listen to this child's struggles to make ends meet and to their concerns about the economy. We should help this child to understand that the RPB is not you, but it is us. Those who lead the RPB are representatives from the 7 organizations that make up the RPB: rabbis, educators, executive directors, development staff, and financial professionals. They have a deep commitment to Reform Judaism and to a dignified retirement for their leaders. The simple child asks, what is this? This child is not financially literate. This individual should be encouraged to learn about the value of planning for retirement and to be introduced to the RPB and its staff and programs so that they know they have a valuable resource that exists to support them. And the one who does not know how to ask never even opens their email from the RPB. This child we ask about their needs, we provide opportunities to learn year by year so that we can help them today to plan for a secure retirement tomorrow. From the widow, living on meager means from her husband's hard-earned savings, to the second career Jewish professional who has a retirement account from an earlier employer, the participant, the professional spouse for whom this is one of many investment tools, to the participant who is the sole income earner of their family, all of whom are working 24/7 to serve the Jewish community. We at the Reform Pension Board are working faithfully and skillfully and professionally to serve you. We are glad that we are at the same table.
Thank you, Rabbi Schindler. For those of us who had the honor and privilege of working with your father, Shalom, it's good to see the tradition continue. And we thank you for your service as a board member in starting this, our initial call. My name is Leonard Teitelbaum, and for just over 100 days, I've been the chair of the RPB. I came into this with a self-imposed mandate best encapsulated in the phrase constituent-centric and the imperative to improve communication with participants. This will take several forms, including the steps Michael has taken to restructure staff assignments to improve response time to your questions. Now, when I conceived of the idea of this call some time ago, I wanted it to be similar to, but not identical to, a quarterly earnings call conducted by public companies, which, if you follow financial news, is going on now. In the financial world, this is known as reporting time. Now, if time permits, at the end of this call, I will preview the general topics of future calls that I have in mind. And of course, we hope this time will prove productive. Now, will this call answer all your questions and concerns? Probably not. Will the call improve? With your help, I promise you it will. For those of you who submitted questions to help guide us to make this call relevant, I deeply and sincerely thank you. I will make you all a promise. Like I said in my initial comments that are still on our webpage, I will listen and I will hear. Now, there's a major difference between thinking something is fact and knowing something is factual. We need to close that gap. What we do know is that the profile of our participants is changing. The older rules and structure may not meet the new profile, and certain changes must, and I promise you, will be made. But I want the changes to be right and responsive and not reactionary. We've been working on some of these problems for a while. It just takes a new approach to make sure that we can comply with all of the restrictions that are imposed upon us. I'll have more to say if there's time at the end of today's very aggressive agenda. Now, I hope everyone is concluding Aziz and Pesach, and I know you did not take time out of your day to hear a speech. So let's get to it. David Baskin, president of Baskin Wealth Management, an incredibly successful money management firm in Toronto, Ontario, and the new chair of our investment committee, will have a few opening comments to help set the stage for where we are today and how we got there. And then Howard Shapiro and I, once David is finished, will begin to ask questions that you have submitted to structure the call. Now, please understand, if your question is not specifically mentioned, but the topic is, we've tried to assimilate these questions into one. So please, this is not personal. This is hopefully more efficient. David, would you please start? And where appropriate, Michael and I may add our comments.
Thanks very much, Len, and good afternoon, everybody. What participants in a pension plan want is no great mystery. Before retirement, they want their contributions to grow steadily so that when they do retire, the amount accumulated is enough to sustain them at a dignified level for the rest of their life. After retirement, they want to be confident that the cash flow from their savings will be steady, that their principal will be secure, and that the funds will last as long as they do. It sounds pretty simple, but as with so many other things, description is easier than execution. Some of you may know my father, Rabbi Bernie Baskin. He's now 96. He's a past president of NAOR and one of the oldest living participants in the plan. He's been retired for over 25 years. When participants think of the plan and what they want from it, his timeline is a good one to keep in mind. Over the 20 or more years that I've been managing money, a lot of things have changed. Consider the companies that led the American market in 2015. Facebook, Amazon, Netflix, and Google, collectively sometimes known as FANG. Together, these four giant technology firms accounted for 107%. That's more than all, 107% of all the gains in the S&P 500. The other 496 companies together lost money for investors. Now, none of these companies manufactures a product. The business sector that Facebook and Google are in did not even exist 20 years ago. Machinery that was once made in Michigan or Ohio or Illinois is now made in Germany, Switzerland, Japan, or South Korea. Clothes that used to come from North Carolina or Georgia now come from Indonesia or Bangladesh. And the computers and cell phones and iPads we use every day are assembled in China with parts made around the world. I bring this up because it's impossible to invest wisely without understanding the economic realities which confront the investment manager. Wishing things were different does not make them so. Here are the realities that challenge investors today. The developed countries are facing strong demographic headwinds. Populations are aging, most prominently in Japan, Italy, and France, but also in North America. Aging populations buy fewer homes, fewer cars, have lower incomes. In short, old economies grow slowly, if at all. World economic growth is happening in younger, more vibrant economies, which are labeled in the investment world as the emerging markets. While the US and Canada are expected to struggle to grow at 2% this year, these countries will grow at somewhere between 4 and 8%, say on average 3 times faster than the North American economies. The growth of globalization has seen manufacturing and assembly move to less developed countries where wages are lower. The loss of high-quality, high-wage manufacturing jobs in the US, so decried in the current election campaign, is real. But those jobs aren't coming back, even if there is a wall built between the United States and Mexico. Corporations, faced with slowly growing or even stagnant markets, are not reinvesting their profits. Instead, they're hoarding cash, sometimes overseas where tax rates are lower, or paying it out to shareholders in the form of share buybacks and higher dividends. The persistent lack of new investment by business in the developed economies of North America and Europe is one of the main factors behind the slow recovery from the deep recession of 2007 to 2009. Finally, investors are confronted by interest rates at the lowest level we have seen in the past 70 years, and there's no sign that these rates will increase. We are faced with a crisis for savers, in which 10-year US government bonds pay less than 2% per year, and bank CDs pay essentially zero. The safe 5% return on bonds and deposits, easily available to all savers for most of our adult lives, has disappeared, and no one knows when or if it will come back. So what is the investor to do? To us at the RPB, it seems clear that the old ideas will no longer produce the desired results. I don't know if any of you saw in today's paper a report from McKinsey, the giant consulting firm, which predicted low returns for the next 30 years. Personally, I have difficulty forecasting the next 30 days, but nonetheless, it's a sign of how the investment climate is being viewed. The simplistic model of 60% in US stocks, stay in the S&P 500, or even a broad index like the Russell 3000, and 40% in bonds seems unlikely to fulfill the goals of our participants over the long term. Let me pause for a minute to consider again what we mean when we say long term and why it is so important. We're now all accustomed to living in the all news all the time world. Quite naturally, when we think about our investment results for the coming quarter, we think about the next 90 days, but really, when we think about the coming quarter, we should be thinking about the next 25 years, the coming quarter century. Those of you on this call who are 70 years old may well live that long, or your spouse might. Certainly those of you under 60 must plan to be retired that long and must invest your savings with this time frame in mind. Here then, in a nutshell, is the thinking behind the goal-based investment program that the RPB rolled out in 2013. Number one, international diversification is essential, and in particular, exposure to faster growing, more dynamic economies will produce better returns. Corporate profits tend to grow with economies. Share profits follow corporate profits. Investing in companies where growth is higher will over time produce better returns than investing in companies in countries where growth is sluggish. This is why the RPB has allocated a significant portion of your assets to managers which invest outside the US. Now, clearly, these high returns don't happen every year. Emerging markets led the world indices in 9 of the past 23 years, with huge returns in 2003 through 2007. Maria, could you please put up the quilt now? I want to show you a chart which illustrates the return on various asset classes over the period from 1993 to 2015. Every color indicates a different asset class, and the higher they are on the chart, the better that asset did in a particular year. But what you will note is it's very difficult to predict what color, what asset class will be on the top of the chart in any particular year. One thing I would point out is that the salmon-colored tile, which is the S&P 500, is only on the top of the chart in 1 year, whereas the emerging markets, a sort of tan color, are on the top of the chart, I think, about 10 years. This is an indication to us that producing returns requires investment in more than one asset class and requires diversification. Thanks, Maria. With interest rates at record lows, a large allocation to passive interest-bearing instruments such as government bonds will lock in and ensure very low returns. It's essential to add new asset categories and broader choices to the fixed income platform to produce any kind of reasonable returns. This is why the RPB added products such as unconstrained bonds and master limited partnerships to its fixed income platform. Our focus, as we say, must be on long periods. History shows us that no one can forecast what asset category or what market will do well in any 1 year. We must look at returns over periods of 5, 10, 20, 25 years to see how we're doing. Now, the revisions made to the RPB plan in 2013 were designed to make our investments goal-driven rather than asset-driven. Instead of offering our participants stocks and bonds in some proportion, we began to offer growth and low risk, again, in a proportion selected by each participant. Has the plan worked out as desired? As the old saying goes, man plans and God laughs. The market has thrown some curves at us, and in particular, some of the newly added asset classes have performed poorly over this short period. Does this invalidate our reasoning and our process? I would say it is far too early to say that. We believe the reasoning behind the plan is rigorous and sound, and that the execution has been well thought out and managed, and that over time, we will meet our goals. Len, I think I'd like to turn it over to you now for some participant questions.
Before Len does that, I just want to remind all our participants on the call and watching to submit their questions, if they have them, to pensionboard@rpb.org. That's the way we can receive them and try to respond later on the call. Thank you.
Thank you. David, I'm going to repeat verbatim this general topic, but a specific question. Under the old set of plans, we could put as much as 80% into equities and 0% into bonds, if we so chose. That served our family extremely well for years. Now the most aggressive plan is only 60% in equities and requires that we have 40% in bonds. We do not want to have any bonds in our portfolio at all. We believe that rates are so low that when they do go up, the value of that 40% of our portfolio will plummet. We don't want to take that risk. Won't you please offer the option to have a higher percentage of equities and no bonds?
Thanks, Len. I think our participant is under a bit of a misapprehension, perhaps caused by the complexity of the plan. Under the new plan, participants can allocate their accounts across one of four funds we offer in any percentage they choose. No restrictions other than those under 60 can't have more than 80% of their account in the lowest risk capital preservation fund. Allocation changes can be made monthly by logging into their Info Express account, accessible from the RPB website. Having said that, because of the makeup of the four funds, participants are currently not able to be solely in equities or bonds. The investment structure put in place 3 years ago was designed to help our participants focus on their objectives, not on particular assets. So for early stage savers or those seeking the potential for greater returns, we created the Capital Appreciation Fund. The fund is primarily invested in global equities, almost 80% of the fund, but is also invested in asset classes like high yield bonds, convertible bonds, master limited partnerships, and real estate investment trusts. These are not to be confused with low yield government bonds or bank certificates of deposits. These types of assets provide additional diversification over pure vanilla equities and also slightly dampen the volatility of an all equity portfolio. On the low end of the volatility scale, we offer the income focused fund. This fund is comprised mostly of bonds, in fact 83% of the fund, but it also invests in dividend paying equities as well as master limited partnerships and commodities. These non-traditional investments for a fixed income portfolio provide for additional diversification, a little bit more yield, and better performance than a strict bond-only type fund. The Appreciation and Income Fund, which basically incorporates 60% of the Capital Appreciation Fund and 40% of the Income Focused Fund, is a simple choice for those looking for a balanced option, similar to what used to be 60% equities and 60% bonds. Finally, the Capital Preservation Fund, the least volatile choice for those who are most concerned about a permanent loss of capital, provides very little upside but no downside at all. Those seeking growth who might have chosen 100% equities under the old system should now be choosing 100% capital appreciation. The upside is similar, but with greater diversification and better downside protection.
David, and I think this gets the heart of almost the overwhelming number of questions that we received. Why were the returns in 2014 and 2015 so disappointing? The S&P 500 grew at 13.7% in 2014 and by 1.4% in 2015. But the return of the Capital Appreciation Fund was negative. Can you explain the difference to this in ways that we can understand it?
Len, I'm going to sound like Rabbi Schindler. There are 4 reasons. The first is the strength of the US dollar over the time period. As this currency went up, the value of investments held in other currencies, such as the euro, the yen, or the British pound went down. The reasons for the strength in the US dollar are complex, far beyond the scope of this call, but we are now seeing a reversal and other currencies are gaining ground. This is one of the reasons why in the first quarter of 2016, emerging markets had a return of 5.7%, leading all asset categories. In 2015, emerging markets was the worst category with a return of negative 14.9%. Maria, this is a good time to put up the slide showing the returns for the first quarter, if you could do that for me.
Sure.
If you take a look at this slide, what you'll see is that the Capital Appreciation Fund had a huge month of March and a positive first quarter. Appreciation income over 5% and income focused over 2%. I can tell you that the reason this happened was that we had terrific results in our diversifying investments, particularly emerging markets, a master limited partnership, and high yield bonds. In other words, the categories which had underperformed in the past have started to do what they're supposed to do and are producing returns. Again, one has to look to the long term, and I'm certainly not telling you that the month of March is a predictor of what will happen forever, but it's an indication that things change. Thanks, Maria. The second reason behind the poor returns in 2014 and 15 was the continuing collapse of interest rates. For the first time ever, we saw government bonds trade at negative interest rates. By the end of 2015, there were worldwide over $7 trillion of government bonds yielding less than zero. This development is absolutely unprecedented and therefore unanticipated. Not surprisingly, bonds returned less than 1% in 2015, and in a flight to safety, high yield bonds showed a loss of 4.5%. Again, we're seeing this trend reverse. High yield bonds returned 3.4% in the first quarter. The third reason that we underperformed is that investment styles go in and out of fashion. The managers that we've selected have a bias towards value investing, and this style has underperformed in the past few years. It's important to understand that even great managers always have periods in which they trail the market. Maria, could you please put up the next slide? This graph shows the performance over a 10-year period of the top quartile of US large cap managers, the best 1/4 of all managers. And what this slide shows you is that 70% of these managers, 7 out of 10 of them, spent at least one 3-year period in the last 10 years, not in the top quartile, but in the bottom quartile. They trailed 3/4 of their peers for a 3-year period, but still ended up being in the top quartile. A third of them did worse, were even in the bottom 10%, and 6% were in the bottom 1% of all managers for a 3-year period, but still ended up in the top quarter of all performers. What this says to me is that looking at any manager over a short period of time is a mug's game. 10 years is a reasonable minimum. That being so, I would note that value as style is making a comeback, and that's also seen in our recent results. The fourth reason for our underperformance had to do with the tremendous drop in price in oil and other commodities. And since 2014, this affected all of our funds except capital preservation. The addition of master limited partnerships and commodities to the portfolio was intended to add exposure to real assets in a time of low interest rates, both as a diversifier and a yield enhancer. It did that, but the very weak prices worked against this strategy in the short term. In the long term, we believe they are worthwhile additions.
David, you bring up a good point in that answer. Let me ask this question. Why do we have active managers? Many studies have shown that investing in a low-cost index fund by way of an exchange-traded fund or low-cost mutual fund gives higher returns than almost all managers. why shouldn't we just go past it? A question that's been before the investment committee for some time. Would you please give your response?
Len, over the past 10 years, we can demonstrate that our current managers have added at least $55 million of value for participants, net of all fees. That's not a small sum, and an approach not to be jettisoned due to short-term concerns. Let me give our participants and those listening on the call some background. One of the great debates in economics centers on the efficient market hypothesis. This theory says that in a modern economy with fast dissemination of news, everybody has access to the same information at the same time, and therefore all stocks and all markets will behave efficiently. That is, they'll be correctly priced at all times. If this is true, it's futile and expensive to try and beat the market. There is empirical evidence to suggest that most managers don't beat their benchmarks. So why are we beating our heads against the wall of both theory and evidence? Two reasons. Most of these studies have considered retail funds. Institutional funds and institutional managers are generally not available to the public and are much less studied. The lack of daily pricing for institutional funds, a subject we're going to address in a few minutes, makes comparison to the market indices difficult, so researchers leave these products alone. We have found and can demonstrate that active investment has added value over time, both due to good asset allocation and due to good manager selection. I should note that our actual cost of active management is about half that of the average active retail fund and not significantly higher than those seen in most passive mutual funds. The second reason is that even among believers in the efficient market hypotheses, even as most ardent supporters concede that while all markets are efficient, some are more efficient than others. The US equity market, the largest in the world, probably is the most efficient, and we have used a passive index part of our allocation to that market. Other markets are smaller, less widely followed, and generally considered to be less efficient. The opportunity for an active manager to add value is more evident in these markets. For this reason, we use a mix of active and passive. A subject that the investment committee is considering is whether to change that mix towards a more passive approach. The jury is out on that.
David, the RPB may believe that active investing works, and as you said, there's empirical evidence that it has added value to our portfolios, but a lot of individuals who are listening today do not. And they want to know why we do not give a choice of selecting passive funds. I believe you've just answered that. And I'll have more to say in a minute. We have charged the investment committee to look at different various paradigms to answer this question exactly, but it has to be done within the legal confines of our funds, and it's not as obvious to many of what this could be. So we hear you, and that is, as David said, is being worked on now. Another question has to deal with reporting. Howard, why don't you take a few of these administrative questions, sort of change up the tone a little here.
Thanks, Len, and thank you, David, for a very full and detailed accounting. Very impressive. Michael, how come I can't see my RPB, how my RPB account is doing each day? Everyone else seems to be doing it that way, including my other investment accounts. So I would like this for my Reform Pension Board account as well. Is there any way that can happen?
We believe that it can happen. As everybody knows, we're known as a monthly value plan, which means that we only are able to report our results to our participants and update their accounts on a monthly basis. We've heard for quite some time now for a number of our participants, as well as from the board, that we would like to explore and, if possible, to go to what's known as a daily valuation model, where we can provide daily updates to accounts. I'm here today to say that we're absolutely committed to finding out how to do it and to do so if we can. As you can imagine and understand and appreciate, this change does represent a fundamental shift, both philosophically and technically. So we have to make sure we're considering this very carefully. We've actually already begun considerations and having conversations with our outside vendors, as well as have we begun assessing which managers we might need to change because of this change. It is on the agenda for our upcoming investment committee meeting on May 11th. And so as soon as we're finished with that meeting and we can go to the board, I will have more to share with our participants on the subject. But rest assured, we're looking at it very, very thoughtfully.
So Michael, I loved seeing how we did in the month of March, but it took 3 to 4 weeks for us to get that information in our inboxes. Why does it take so long?
Well, as I said, Howard, we are a monthly value plan. And what that means is that some of our managers don't even report their numbers to us until at least the 8th or 10th business day after the close of the month. Only then can our outside vendors, which include ABG, our record keeper, and Northern Trust, our custodial bank, only then can they begin to reconcile the balances, update participant accounts, which also takes a few extra days.
And rebalance.
And of course, we also have to rebalance the portfolio. Moving to daily valuation, as we just talked about, imagine we're going from a timeline that takes 3 to 4 weeks to one that will have to take hours. So this does represent a big change. We know that most plans out there are already daily valued, but making the actual change is not an easy feat, but again, one that we're committed to.
Thank you. I also have other investment accounts and receive a very transparent and clear statement. Why can't the RPB issue more transparent reports and provide online access showing us personal monthly, quarterly, and annual returns?
Howard, I have to say that we're actually very much looking forward to be able to do exactly that and more. One of the things that we're in the midst of is actually our record keeper, ABG, was just recently acquired by Alaris, which is a larger record keeping and banking organization. They're not going to be finished integrating their system until later this summer or early fall. So it's actually at that time where we'll really learn what the full capabilities available to our participants will be. And rest assured, we're going to make best use of Alaris and what they can offer us to all our participants. And of course, we'll let everyone know as we learn more about that.
And then there's a question about over the lifetime of our accounts. How are we supposed to determine what our returns have been over the lifetime of our account?
Well, we appreciate that, and we would actually love to be able to provide lifetime returns for everybody. But due to the lack of data that we have, we'll only be able to provide lifetime returns for those that joined the plan starting in 2005. Prior to that, we just don't have all the raw data available to enable those returns to be calculated. Again, this is something we are going to work on and provide for those, again, that started in 2005 or after.
So one of our participants asked, Michael, how I would like to see how each fund is invested and the performance of each manager within the fund. Can we do that?
Well, in fact, we already have up on our website today how each fund is invested, specifically which managers, what investment style or asset class that manager is supposed to be invested in and is invested in, as well as the percentage allocation that we've given to that manager across each of the 4 funds. So that's available today. What we don't yet have up on our website is the performance of each of those managers. As part of our plan to become more transparent, to provide more information to our participants on investments, on returns, and as well as on other relevant metrics, we're going to look to put all of that information up on our website as part of our relaunch of our website, which will come at some point in the near future. We have a lot of work to do. You've heard already about a lot of the work ahead, and trust me, this is something that is really important to us, because I know it's really important to everyone that's in the plan. And again, we'll let everyone know when we have more to share.
Costs, sorry, Howard.
Oh, go ahead, Lynn.
No, costs are always a bit of a problem, or not a bit of a problem, a major problem. So, Michael, I think you might be the one to answer. Can you tell us what all the yearly expenses are associated with our plans?
Absolutely. Reed, could you put up the next slide? Thank you. As you can see, our costs are broken down into a few different categories. They include investment management, administration, as well as custody, record keeping, and investment consulting. We express our fees or costs in basis points, where 1 basis point is the equivalent of 1/100th of 1%. First, let me talk about our investment management fee, which you can see on the screen. We have the capital appreciation fund at 68 basis points annually, going down to the capital preservation fund, our most conservative fund, our least volatile fund, at 38 basis points. Before I talk about administration and the other costs, one of the things, and David alluded to this earlier about active versus passive management. As he mentioned, our managers have added, since we've owned them, $55 million, about $55 million of value. That is after fees. That's after the fees you see on this screen. The fees you see actually are very, very competitive in the active management space. The reason for that is because we're considered an institutional investor. And as such, we get much more favorable rates than the average mutual fund investor. According to Morningstar, the average actively managed mutual fund is actually almost double the cost of the capital appreciation fund, about 120 basis points annually. And in fact, even passive mutual funds are in the neighborhood of 50 basis points. So given the fact that we're almost fully actively managed, not entirely, we do have a few passive investments, we believe that this is a very competitive cost structure for a plan like ours. In addition, we have our administration at 20 basis points, and this covers all the costs of operating the RPB, basically keeping the lights on. It actually covers not only the things you would expect, like rent, salaries, office supplies, all the things that one has in the budget. It also includes things that you might not have realized, which includes the basic life insurance subsidy that everyone gets to enjoy, well, hopefully not enjoy, but is covered for, the pension continuance insurance subsidy, as well as the financial counseling services of Ceridian. Those are also included in these costs. The third type of our cost structure are the custody, record keeping, and investment consulting fees, which is 6 basis points on an annual basis. These are the costs related to tracking and processing all the money coming in and going out, tracking each participant's account in detail, as well as the professional advice we receive from Summit Strategies, our outside investment consultant, on investment allocation, manager selection, analytics, reporting services, and other special projects we ask them to do for us. This is all included in this cost. The investment management fees are deducted directly from returns by each manager, while the other fees are charged by the RPB directly to each participant's account. Final comment on our costs. We actually have recently benchmarked our administrative, custodial, record keeping, and investment consulting fees, and we found that they're actually very competitive for a plan like ours. So that is in a nutshell what our cost structure looks like, Howard.
I'd like to ask a question about portfolio rebalancing, choice, of course, by the participant. How often are the portfolios rebalanced, Michael? And if allocations are charged by a participant, how long does it take for this to go into effect in the new month?
Well, Leonard, there are 2 ways that portfolios are rebalanced. The first is at the fund level, and the second 2 are at the participant level. First, it's important for everyone to understand that the RPB maintains a target allocation for each manager. This is established by the investment committee per the advice and counsel of Summit Strategies. Each month, after the month closes, we trade back to the target based upon a number of things, which include whether the markets have gone up or down for each manager, whether we've received additional monies coming in the form of contributions, or if monies have gone out in the form of distributions. So all of those things go into a magic box that we then process to execute these trades to get back. This is actually very important for us to understand, and David talked about this a little earlier. This process, by trading back to target each month, keeps us from timing the market, and it's a very key way we stay invested all the time. It actually forces us to sell high and buy low, which is exactly what you would hope we would do for our participants. Second way is that the participants can change their allocation across the 4 funds on a monthly basis, and that takes effect the first of the following month. Third type is also at the participant level. This occurs once per quarter, and it's only for those participants who are invested in more than one fund. If because of gains and losses in their account goes out of balance across the funds that they've chosen by more than 50 basis points, that's half a percentage point, we automatically rebalance their account back to their chosen target allocation. So those are the ways we rebalance.
So Michael, I have about 3 or 4 more questions that hopefully we can answer quickly, because we want to be able to leave some time for participant questions. So this is something I would have wanted to know as well before I retired. In retirement, what's the most common asset allocation for retirees that participate in the plan?
Howard, we get that question a lot here in the office, as well as I get that question a lot when I'm on the road meeting with participants on an individual basis. And this is what I've always said and will continue to have to say. There really is no one most common asset allocation for retirees or non-retirees. Only each person knows what other investments they have and also what their appetite for volatility or risk is for their RPB assets. What I can say are the following facts. 13% of retiree money is invested in the Capital Appreciation Fund. 54% of retiree money is invested in the Appreciation Income Fund. 21% is in the Income Focus Fund, and 12% is in the Capital Preservation Fund.
Thanks. So I find RPB Info Express a little bit cumbersome, not very user-friendly. Is there another platform being considered?
In a matter of speaking, there is, in the sense that ABG, which is what you see when you log on to Info Express. So when someone logs on, they're actually logging on to the ABG platform. Once we go live with Alaris, which is our new record keeper, later this summer or early fall, they will see a very different user interface and be able to experience much more, we hope, much more user-friendly platform for participants. So we just need to be a little bit more patient while this integration completes.
Here's a question that I think I'm going to answer, Michael. You don't have to answer it.
Okay.
Because it's got to do with parsonage. And I was the chair of a parsonage task force that had on it Buzzy Billfield, Steve Fox, Ani Sher, Alice Gunn, and Robert Perry. And so the question is, and I'm going to read it exactly, will the RPB follow the same slightly confusing system regarding parsonage in which we declare up to 100% and then change it as we figure out the actual numbers? So the answer to that question is really very simple. The task force has met, is in the process of trying to figure out how best the RPB can help our participants in planning their parsonage. We are in the process of suggesting changes, and we will inform everybody how we can do this most efficiently and in the least confusing manner in the months to come. So it's in the process of being done. And thank you for the question. And lastly, Michael, I'm not answering this one. Is there some way to shorten the time from making a withdrawal request to having a check sent out?
Well, as everyone knows who is retired and currently taking distributions are processed once a month. Notification deadlines for when we would be able to make a change to somebody's distribution. We do need to do a little bit of a better job of establishing firm deadlines and communicating those out. So we're still working through what makes the most sense for our participants and our office to make sure they're processed in a timely manner and an accurate manner, which is first and foremost the most important thing. And as soon as we get those deadlines set, we will communicate with everybody.
Thank you, Michael.
You're welcome. So I believe this does bring us to the end of our time responding to questions we've received in advance. Now, let's see what questions might have come in during the call. While we were speaking, I think a couple have come in, and let me read them to you. How has the new socially responsible investing policy been implemented? That's a great question. I actually just a couple of weeks ago was invited to speak to the Commission on Social Action on just this very subject, on our Jewish values investing policy and how it's been implemented. In the remaining time, in all honesty, we really don't have the time to give that justice. And in fact, and Len will mention this again in a couple of minutes, but we do plan to have a call dedicated to this subject. It's very important. This is actually not the only time this question's been asked. And we do want to make sure we're communicating with our participants on this extraordinarily important subject. So please be patient. A future call, either the next one or the call after that, we'll have something on this subject.
Let me just add one quick thing to that. Michael is absolutely right. But we do use a JVI screen to our managers or our advisors. We have a questionnaire submitted by a firm specializing in Jewish value investing, and they rate each manager that we have for JVI initiatives. So we are starting the process. We have it partially integrated, and I will say in a few minutes, I want a call dedicated specifically to that topic. Michael, we have
one other question that has come in. The RPB appears to buy a market basket of stocks, bonds, etc. Why not skip the middle managers and go right to the index funds? Good question. I think David Baskin a little earlier addressed the rationale behind our decision to invest mostly with active managers. We do in fact have a couple of passive index-oriented investments, but like we said earlier, the majority of our managers are actively managed and has added value for our participants. And so that is beyond all the technical reasons about market efficiency that David talked about earlier, why we stay invested in the managers we do. Robert, any other questions that come in? Okay, well, that looks like that's the end of the questions. We're going to start to wrap things up. I know this has been a very long call with a lot of density to it. Hope this was a good experience for you guys. But before I turn it over to Len, I just want to take this one unique opportunity to acknowledge and thank the entire RPB staff for all that they do. You see them on the screen as we speak. They're an incredible group of people. Some been with us a very long time, upwards of 25 years, all the way down to our newest member of our team, Julia Kim, who's been with us just a couple of months. And so I do want to acknowledge and thank them for all that they do. Len?
Yeah, let me close by saying on what we hope to achieve on future calls. So unless I hear differently from you, I would like to always have a review of the quarterly performance and any recent governance items that would affect you as a participant. As a focus of our next call, the discussion of the progress made by the investment committee on 3 items that I have charged them with. They are choice, passive versus active, and daily valuations will be discussed. We talked about that a lot on this call. It's about time to try and bring some closure to this item. If I had had patience, I'd have been a doctor like my mother wanted. So we are looking for a resolution to these questions, at least on a progressive state. Now in the future, I also want to have a call focused on addressing investment advisors. I envision those who utilize outside advisors and those who utilize Ceridian to invite your advisors to attend this call and have them attend with you so they, you, and we can be on a common ground. Also in the future, I would like to have a representative of our outside advisors, Summit Advisors, present a retirement readiness study that they gave to the full board recently that everyone found not only enlightening, but factual as to what the realities are. Also in the future, as we've just talked about, the area of JVI needs further discussion and public airing. Please use our website for dates of the upcoming calls and further information. Now as a final point, after this call, you will be receiving a survey asking for your feedback. Please respond. I don't care if it's positive or negative. Either will provide valuable guidance. And lastly, I want to thank your board and investment committee for donating their extremely valuable time. To Michael and the rest of his office staff, those listening in will not know the hours of time that you put in and are rarely thanked enough. Any administrator, educator, or rabbi with minimal support knows the difficulty in replacing 40% of the staff and trying to make it seamless. Michael, you and your colleagues are doing it. You deserve all of our respect and thanks. In addition, people should know that Michael is upgrading all of our systems, trying to bring this office into the current century. When I came, I must admit, I knew very little about the computer systems. I know that sometimes because of their date and technology, it puts us behind the curve. We want to get in front of the curve, and we don't want to make it our life's work. We have deadlines imposed, but I do not want to overpromise and underdeliver. But for Michael, for what you and the staff does, I sincerely want to offer my personal and the board's thanks. Now, as Pesach draws to a close, and we prepare for Yizkor and Shabbat, let us never take for granted the freedom we and those we hold dear can experience. Also, let's be grateful we only have a few more boards of matzah to consume. Talk about the bread of affliction? I don't know. Shalom, shalom. It's all. We look forward to having you on our next call.
Thank you, everybody.